So now that we have an understanding of what is in the banking book and what issues we need to consider if we have a trading book as well, I make sure that there is clear separation between them and their activities. Let's have a look at the interest rate risks themselves. First and foremost, every bank is exposed to this. It's what we generally call gap risk. In some countries they call it mismatch risk. The gap risk simply arises, even if it's floating rate. The gap risk arises because contractually and to a large extent behaviourally, the expected life, the maturity of liabilities is different to the expected life of assets. And this gap between the two positions means that when interest rates change, whether they go up or down, as my rates change in a floating rate or indeed in a fixed rate book, as my rates change for the customer, unless I've matched everything off in terms of interest rate basis and tenor, I will have a change in my net interest income. So this is the primary interest rate risk that all banks have to manage. As I said, every bank has this exposure. And I'm not familiar with any bank that I've ever come across that does match precisely contractual and interest rate tenors. There's always some mismatch arising, so all banks are exposed to gap interest rate risk. I've got there a slide that says gap risk is normally associated with parallel shifts in the yield curve. What that should really say is gap risk is normally measured and identified with parallel shifts in the yield curve. It's not associated with it because it exists whether there's a parallel shift or not. So in that respect, that word there is the wrong one. It shouldn't be associated. We simply assess it. We assess gap risk with an assumption of parallel shifts in the yield curve, which of course don't actually happen. When the yield curve moves, all the points along it don't change by the same amount at every point along the curve. One doesn't observe parallel yield curve changes at any time for any reason in any jurisdiction. However, that's a convenient way to assess our exposure, our sensitivity to a change in interest rates. Non-parallel gap shift is just that, gap risk, I should say. Non-parallel gap risk is just that when the curve moves as it does in the real world by different amounts of magnitude along different points of the term structure, then we have an exposure arising, and so of course we want to measure that as well, or at least be aware of it. It's still gap interest rate risk, but we want to assess our sensitivity in a more realistic manner if we can. Basis risk is defined as a risk exposure that impacts my income arising as a result of changes in one or more interest rate basis that my balance sheet has connection to. Explicitly, for example, I've got written down there the central bank base rate and 3-month LIBOR. Now, SONIA is the sterling's overnight index rate. So whatever jurisdiction you're in, your overnight interest rate changing with your 3-month reference rate, your 3-month LIBOR, if you like, that's a basis risk as well. One other type of basis risk is when assets or loans on the balance sheet are linked to, for example, a reference rate like the T-bill rate or the central bank base rate or 3-month reference rate, 3-month LIBOR, and your assets may be linked to that, and your liabilities or deposits are linked to your own bank's administered or customer interest rate. Your customer interest rate, for example, what you pay on customer deposits, isn't an explicit publicly quoted reference rate. It's your own rate, but you will set it in line with the market. You'll set it in line with your peer banks, your competitor banks, and also with market interest rates. So, of course, where you have certain products on the balance sheet linked to your administrative rate or your customer rate, and other products linked to an explicit reference, that's a form of basis risk as well, because your interest, your income, your revenue, your earnings will be impacted when one or both of those rates change at any one time. I've also written a little text there about tenor basis risk, the risk that positions, despite repricing on the same date in the same currency and the same reference benchmark, reprice differently because when they reprice, it's at different tenors. So, for example, you might have loans and deposits linked to 1 month and 3 month floating, or 3 month and 6 month floating reference rates. So that's tenor basis risk. Optionality risk. You can have automatic or explicit option risk when you have a position or an instrument on the balance sheet that has optionality in it. Also, you can have behavioral option risk, which is out of your control. That's when customer behavior results in products, either loans or deposits, having a different life to what the stated contractual life of that product is. So which means you're going to either lose out on income that you were expecting to receive because of a loan that was going to a certain maturity, or you're going to not have to pay interest that you were expecting to pay on a deposit that has finished before or after its contractual term. So that's behavioral option risk, and that, of course, is harder to measure and to manage. So one has to make assumptions about this customer behavior if one is going to estimate what the exposure to this is. Here are the different types of behavioral option risk: pipeline or pre-hedge risk. For example, when you offer a loan to a customer, you send them a letter saying we have now approved your loan, the money will be available in your bank as when you request it. In some cases, customers don't proceed with the loan. You may well have approved that loan and then set up the funding and or the interest rate risk hedge for that loan in advance, expecting the customer to draw down on it, and then the customer doesn't draw down on it. So that's a type of behavioral option risk. Prepayment or early repayment, again, as I just mentioned now, a customer can repay a loan earlier than the scheduled date, or they can break a deposit earlier than the scheduled deposit maturity date, which is the early redemption risk point.